CleanSpark just signed a massive $6.6 billion AI lease that sent its stock surging 14% in a single day. But beneath that flashy headline is a terrifying reality. They are sitting on a $1.8 billion debt mountain and facing a massive capital gap that could unravel this entire turnaround story before it even truly begins. To understand why this matters right now, we have to look at the massive tension between this shiny new AI hyperscaler contract and the sheer staggering cost to actually build it out. This explainer is going to show you exactly how a single contract is radically transforming a legacy crypto miner into a high-stakes AI infrastructure play, and why the market is entirely split on whether they can actually survive the transition to pull it off. To grasp the stakes here, we first need to look at what CleanSpark actually does. They're a digital infrastructure developer currently operating two radically different business models. Historically, they've been a pure-play, institutional-grade Bitcoin miner. In that legacy model, they use high-powered computing units to validate the Bitcoin network, and they make their money from highly volatile block rewards. But right now, they're desperately attempting a Trojan horse pivot. They're transitioning their massive energy capacity away from that cyclical, unpredictable world of self-mining and directly into the highly predictable but incredibly expensive AI data center colocation market. It's a dramatic shift. They're moving from unpredictable daily crypto revenues to predictable 20-year triple net leases with global technology giants. So you might be wondering, why are these capital-rich technology hyperscalers choosing CleanSpark instead of traditional real estate developers? Well, it all comes down to one critical bottleneck, and that is power. AI hyperscalers are absolutely starved for grid power right now, and CleanSpark's true competitive moat in this space, it's incredible. They already control an immense 1.8 gigawatts of contracted, fully approved energy capacity across Georgia and Texas. That is a massive head start in today's grid-constrained environment where getting new capacity approved can literally take years. Plus, they utilize a specialized off-site prefabrication supply chain that cuts on-site construction labor by up to 70%. This allows them to deploy physical data center capacity much faster than the competition. And once a tech giant installs their massive proprietary high-density computing clusters in these specialized facilities, the switching costs are astronomical. They are locked in for decades. Because of this, their economic engine is radically shifting. They plan to turn their 175-megawatt Sandersville campus in Georgia into a specialized AI hub. This specific campus is the anchor for a 20-year triple net lease with a high investment-grade tech firm, and it is expected to yield a near 100% net operating income margin. Why? Because the tenant covers property taxes, insurance, and maintenance. Oh, and by the way, if this kind of deep, research-first analysis is your thing, you probably want to subscribe. But here is the central conflict that the market is absolutely terrified of. Traditional cryptocurrency mining sites cost about $700,000 to $1 million per megawatt to build. But AI infrastructure, that is a whole different ballgame. Specialized AI data centers cost landlords $10 million to $12 million per megawatt to build. We are talking about an exponential leap in capital requirements that completely rewrites their balance sheet. This exponentially higher cost builds a massive roadblock. For the initial 175-megawatt Sandersville build-out alone, CleanSpark needs to spend up to $2.1 billion in capital expenditures. Yet, as of their latest reporting, they are sitting on just $260.3 million in cash and cash equivalents. This creates a severe funding bottleneck. They simply do not have the liquid capital on hand to fulfill this $2.1 billion requirement without making some drastic financial moves that could suffocate their grand AI ambitions. Basically, they are attempting to build an ocean liner with the budget of a speedboat. The most recent financial evidence proves exactly how precariously positioned they are while trying to execute this pivot. Their recent Q2 fiscal year 2026 earnings report, which came out on May 11th, exposed a severe cash burn while they desperately try to fund this monumental transition. The crucial point is right there in the numbers. Quarterly revenues came in at $136.4 million. That completely missed Wall Street expectations by nearly $12 million and represents a 25% drop year over year. Even worse, the company absorbed a staggering $378.3 million GAAP net loss, translating to a negative $1.52 per share. Now, to be fair, a large chunk of this loss was driven by $224 million in non-cash fair value losses on their Bitcoin treasury, just due to price volatility under new accounting rules. But even backing that out, their adjusted EBITDA still plunged to a negative $241.2 million. Their operations are burning cash heavily just when they need it the absolute most. Initially, the market reaction was brutal, with the stock dropping nearly 6% after those terrible earnings. But then, on July 14th, they announced that 20-year Sandersville AI lease. That announcement violently shifted the narrative. The stock spiked 14.64% in a single regular trading session. Investors immediately bought into the long-term AI turnaround story, pretty much entirely looking past the immediate cash burn and the massive capital deficit. So, when we step back and run all this through our qualitative business quality scorecard, CleanSpark lands at a highly polarized 6.5 out of 10 blended score. This perfectly reflects a balanced but extremely speculative hybrid risk profile. You have a company with world-class physical power assets but highly strained operational financials. Let's break down those extremes, because they really tell the underlying story. They have a phenomenal market position, scoring an 8 out of 10, because controlling 1.8 gigawatts of power and achieving 50 exahash, which is an absolutely massive amount of specialized computing capacity, is just top tier. Analyst sentiment is also a massive 9 out of 10, with overwhelmingly bullish price targets. But on the flip side, profitability is an abysmal 4 out of 10 due to those massive recurring GAAP net losses. And capital allocation? That sits at a highly questionable 5 out of 10. Why? Because late last year, they issued $1.15 billion in zero-coupon convertible notes. They essentially borrowed massive amounts of money that can later convert into shares, heavily diluting current investors. And then, they chose to spend $460 million of those exact proceeds on share buybacks. They bought back stock when they desperately needed that exact cash for AI data center construction. That is a strategic decision investors really need to weigh carefully. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it services the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; and dividend hunters, durable income with the fundamentals to back up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of your screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's get back to the analysis. Now, before we dive into the 5-year valuation framework, I must clearly state that this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's look at what the next 5 years, out to 2031, could actually look like. We are starting from a baseline share price of roughly $12.36. The spread here is absolutely staggering. We have a high case target of $39.42, representing an annualized return of over 26%, all the way down to a low case of just $1.01, which would be an almost total wipeout. This spread perfectly illustrates the massive binary risk of this transition. It is either a monumental grand slam or a complete strikeout. Now, the operational reality of hitting that $39 high case is massive. For this to materialize, CleanSpark must successfully transition not just the 175-megawatt Sandersville campus, but their entire 885-megawatt Texas portfolio into active paying AI leases. That would give them 1,060 megawatts of contracted capacity. This massive scale would drive year 5 revenues to $2.15 billion, operating at a highly lucrative 35% net margin. If they execute that perfectly, the market will revalue them as a pure-play infrastructure provider, applying a 22 times price-to-earnings multiple. But remember, achieving this scale requires over $10 billion in outside financing to build out that infrastructure, which means outstanding shares would likely swell from 256 million to roughly 420 million due to heavy dilution. The base case models a partial transition. We assume Sandersville comes online, but only about 300 megawatts of the Texas portfolio transition. This leaves them with a hybrid model of data centers and legacy crypto mining, generating just under $1.2 billion in revenue. Operating at a 25% net margin and valued at a 15 times multiple, this results in essentially flat returns from today's price. The low case, though, demonstrates what happens if execution completely fails. If funding dries up, the Texas exclusivity expires, and standard mining margins remain depressed, revenues compress to just $480 million. They'd be forced to massively dilute shareholders just to keep the lights on, driving margins down to a meager 8% and compressing their multiple to a 10 times standard mining valuation, which drags the stock all the way down to $1. By the way, if you want to dig into the math, you can check out the full model with all detailed assumptions at flashstocksentinel.ai. Looking at those wildly divergent scenarios, we have to ask the critical question. What could break this thesis entirely? The biggest threats to this company aren't just broader macroeconomic forces, they are severe, company-specific execution risks that could trigger a total collapse of the AI pivot before it even gets off the ground. First, investors must watch out for massive customer concentration risk. They're incredibly dependent on a single, confidential tenant at the Sandersville campus. If that tenant backs out, breaches the contract, or shifts strategy, CleanSpark is left holding a highly leveraged, multi-billion-dollar empty shell. Second, you have strict lease construction milestones. The contract literally stipulates that if CleanSpark misses their financing and delivery timelines, the tenant can demand severe rent abatements or just cancel the lease outright. And finally, the balance sheet risk. As we touched on earlier, they issued $1.15 billion in zero-coupon convertible notes due in 2032. That creates an extreme dilution overhang. If they can't fund the $2.1 billion Sandersville construction with operating cash flow or new traditional debt, they'll be forced into highly dilutive equity raises that will absolutely crush existing shareholders. Pulling it all together, the verdict on CleanSpark is a story of incredible ambition racing against a ticking financial clock. Can they survive their balance sheet long enough to become an AI giant? Ultimately, they have secured a golden ticket with a highly lucrative $6.6 billion AI lease. They possess a world-class 1.8 gigawatt power moat that hyperscalers are absolutely desperate for. But they are in a massive race against time to survive their $1.8 billion debt load and a severe capital deficit before their legacy mining margins compress entirely. They have the right asset at the exact right time, but the execution risk is off the charts. So, the question remains, will CleanSpark become the infrastructure backbone of the AI revolution, or will it be crushed under the weight of its own massive ambition? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.